Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about SF Holding Co. Limited, latest report. SF Holding Co. Limited offers a diverse range of businesses and services that cater to various needs of its clients. The company's primary focus is on logistics and freight forwarding, which includes express and large-volume logistics, instant delivery in the same city, supply chain management, and international services. The company provides courier and express services both domestically and internationally, as well as technical maintenance and development services. It also offers freight transportation services and value-added telecommunication services to its clients. In addition to these core services, SF Holding Co. Limited provides a range of specialized services such as air cargo and mail service, e-commerce industrial park management, consulting and management consulting, and industrial investment and property leasing. The company's services also extend to information technology, business management, business information consulting, and enterprise management consulting. Furthermore, it offers time-sensitive express, economical express, cold chain, and pharmaceutical logistics services, as well as instant and last-mile delivery services. The company operates through its subsidiary, Shenzhen Mingde Holding Development Co., Limited, and is headquartered in Shenzhen, China. SF Holding Co., Limited market capitalization of $218 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that SF Holding Co. Limited holds a significant advantage in their industry. SF Holding Co. Limited trades at a higher price-to-earnings ratio of 14 times and a higher price-to-book ratio of 1.6 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 49% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 2.79%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be categorized into several key areas. Revenue growth drivers, global expansion, and increased market share in China have been significant contributors to revenue growth. Technological innovation in logistics, particularly in green and low-carbon capabilities, has also driven growth. Additionally, data security and privacy protection, safe delivery and transport capabilities, and climate change mitigation efforts have all contributed to revenue growth. The company's ability to adapt to changing market conditions through technological innovation, such as the development of sustainable fuels and digital supply chain platforms, has also been a key driver of growth. Furthermore, expanding into new business areas, increasing revenue scale through efficient delivery of energy management initiatives, and optimizing energy structure have all contributed to revenue growth. Revenue decline drivers. On the other hand, several factors have led to revenue decline. Logistics disruptions due to extreme weather events such as typhoons, floods, and high temperatures have resulted in increased maintenance and operating costs, leading to a decline in revenue. Stricter policy supervision and international compliance requirements have also put pressure on operating costs, contributing to revenue decline. Energy price fluctuations and stakeholder concerns have also had a negative impact on revenue. The company's ability to mitigate these risks through technological innovation and adaptation will be crucial in maintaining revenue growth. Net income and profit margins changes. A comparative analysis, the analysis of net income and profit margins, reveals distinct changes driven by varying factors. On one hand, net income increased due to reduced operational costs, enhanced customer loyalty, and revenue opportunities on page 63. Conversely, on page 113, the increase in net income can be attributed to efficient logistics decision-making, reduced labor and transportation costs, and digital solutions revenue. Similarly, profit margins improved for different reasons in each summary. On page 63, lower energy consumption, strengthened bargaining power through green service capabilities, and overall logistics costs contributed to the improvement. In contrast, on page 113, enhanced operational efficiency, reduced trunkline transportation costs, sorting, and timeliness delays, as well as improved cost-effectiveness and revenue quality through operational intelligence, led to the increase in profit margins. The divergence in reasons for change highlights the complexity of factors influencing financial performance. Understanding these distinct drivers is crucial for informed decision-making and strategic planning. The financial documents reveal a mixed performance across various regions and segments. On the positive side, China and Asia have been standout performers, ranking number one in multiple segments and demonstrating significant growth opportunities. The overseas business segment has also shown improvement through strengthened risk management and compliance systems. In terms of specific industries, new energy vehicles have experienced rapid growth, while distributed photovoltaic projects in Asia, particularly China, have generated substantial amounts of electricity. Chengdu Xuangliu Industrial Park and Urumqi, Xinjiang Industrial Park have been notable success stories, producing over 100,000 MWh and 42,000 MWh of green electricity respectively. Furthermore, various business segments such as logistics packaging, low-carbon transport, multimodal transport, Punti region, Yunnan blueberry industry, and nationwide delivery services have performed well. However, there is a mention of potential fluctuations in market prices of clean energy that could impact cost control in transportation and warehousing operations. Overall, the financial documents highlight a strong performance across multiple regions and segments, with some areas showing significant growth opportunities. Management is emphasizing the importance of integrating environmental, social, and governance (ESG) principles into the company's corporate development strategy. This includes establishing a clear and transparent ESG governance framework and setting sustainability goals aligned with its strategies and development situations. The company is committed to long-term success, upholding integrity as its cornerstone, and aiming to be the world's leading digital intelligence logistics solution provider. To achieve this, management is strengthening risk management to ensure sustainable development, proactively identifying and assessing ESG risks, and formulating response strategies to reduce operational risks and losses. In terms of sustainability, SF Holding is committed to supporting the national dual carbon strategy and the 1.5 degrees C temperature goal of the Paris Agreement. The company is focusing on a low-emission scenario due to stricter policy supervision and faster technological innovation, investing in low-carbon transformation technologies, and engaging in industry-academia research collaboration. Management is also prioritizing green logistics by continuously enhancing fuel efficiency management and reducing overall fuel consumption through a dual strategy that integrates management enablement with concrete operational measures. Additionally, the company is building a responsible supply chain through green procurement and supplier management, prioritizing eco-friendly products and materials, and incorporating ESG requirements into supplier contract terms. Furthermore, management is focusing on talent development by enhancing employees' professional abilities and industry competitiveness through a diversified learning and development system. The company aims to build a learning-oriented organization and cultivate high-quality talents. Overall, the company's strategy emphasizes sustainability, long-term success, and responsible business practices, with a focus on ESG integration, risk management, green logistics, supply chain management, talent development, safety management, community investment, and sustainability disclosure. Concerns about inventory buildup and supply chain disruption are present in the extracted summaries. On page 59, natural disasters such as typhoons can disrupt logistics flows, leading to cargo backlogs and delayed deliveries. Additionally, high temperatures can strain cold chain logistics systems. Supply chain disruption is also mentioned on page 61 as having a medium to high impact due to policy changes and technological risks in logistics and operations. Furthermore, traditional warehousing models may lead to inefficiencies, and elevated return rates are experienced in the apparel and footwear industry. However, these concerns are addressed through the company's solutions, which include reducing labor requirements by 60% and lowering MES delivery rates by 98%. The The company has also decreased slow-moving inventory by 35% and achieved zero mismatch and accelerated inventory turnover. That concludes the financial summary for SF Holding Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.